Hi guys, welcome to another video by Optionables. My name is Saket and in this video we are going to look at the trades taken on 9th of August as well as 6th of August. So the thing is, both the days we almost ended with no profit, no loss or minimal gains. So on Friday we ended with a gain of around 20,000 and today we ended with a gain of somewhere close to around 15,000. So both days put together, if you actually end up subtracting the brokerage, we have ended with no profit, no loss. So I am going to show the screenshots of both today as well as Friday. So post which I am also going to show couple of positional trades which we entered today. So today we entered lot of calendar spreads and I am going to show you all of these trades and the logic behind that. And finally, the most important thing is, in the previous video there were a couple of things which I wanted to clear. So this is the video regarding the future strategy. So the thing is, here the video was mainly intended to show simple analysis of data is sufficient to create profitable strategies. So the thing what you have to note here is, as I had already mentioned in the video, so when you know that the market usually tends to open higher, the best strategy and the cheapest option for you would be to go for a bull call spread. And since we had already made a video on bull call spread, I thought I'll be making a video on futures. So that's the reason I actually ended up using futures in that example. So you can definitely tweak a lot of this and you can do further analysis and add your own data points into that and you can improvise the strategy. So that is point number one. Point number two, with regards to brokerage and charges, so per day it is going to cost you somewhere close to 2000 rupees if you are going for 10 lots. So if you are doing this with one lot, it is not going to work out really well, but if you do this with 10 lots, your average expected profit per week is going to be somewhere around 15,000 and brokerage and charges including your STT and everything is going to come to around 5,000. So which means if you keep on repeating this week after week, you are expected to end with a profit of 8 to 10,000 every week if you do for 10 lots. So not for one lot, but if you do for 10 lots. Most of the strategies which are shown on this channel are going to work out better with more number of lots, because the cost of execution of this is remaining the same whether you go with one lot or 10 lots. So the STT and all turnover charges, all those are going to increase, but your brokerage as such is going to remain the same because it's 20 rupees per order end of the day, whether you shoot one lot or 10 lots. So the more number of lots you go, it is much better in terms of saving your brokerage. So that is a few things which I wanted to clear, and now we'll be quickly jumping into the video and we'll look at the positional trades as well as the intraday trades as well, and finally we'll be filling in the Excel sheet also. So I hope you are liking the content on this channel. If yes, then please do hit the like button, share and subscribe. Thank you so much for joining, guys. Welcome to another video by Optionables. So what you can see on the screen right now is the today's trade. So from the broker's terminal itself. So you can see that today we have made a overall profit of around 15,000, but most of it is going to go to brokerage. And unfortunately, I have deleted the yesterday's video and I don't have the screenshot of the video on 6th, that is Friday. So the thing is, I actually went to the back office and saw the contract note. Since we had taken some positional trades, the credit is showing around 5,50,000. You can see that right here. The trade date is 6th of August and option obligation is 5,50,000. The thing is, intraday we only got a profit of around 20 to 25,000 and some are positional credits which we actually got. So we received some positional credits because we had shorted options. So we are going to consider this as 20,000 again, and we are quickly going to fill in the Excel first and then we'll continue with the positional trade review where we have done some calendar spreads, actually a lot of calendar spreads, and we are going to review each one of them in detail, and we are also going to see what was the idea behind taking these trades. So on 6th of August we made around 20 to 25,000, so I'll just put this as 22,000 and 17,500 as brokerage. And today we made a profit of somewhere close to 15,000 and 17,000 again, 17,500 as brokerage. Okay, so this is 1,75,000. Sorry for that. Right. So all in all, you can see that we have not made some big progress. We are just where we are. So gross profit wise, even though we have got a profit of around 35-40,000, we have paid almost 1 lakh in other charges. And net we are at a loss of 80,000. So considering the start we have got in first 9 days, we have actually made no progress in August. So it is quite hard for us to achieve 3% itself because we only have 20 days remaining, and that too not all 20 days are trading days. So now we can actually forget about going towards 5%. So we'll try to see if this 3% is achievable or not. So now we'll be moving on to the positional trades which we have taken, and I'll be showing you that as well. And as you can see here, we have lot of positions entered, and all of these positions are calendar spreads. So I'm going to explain one by one separately. So we have BankNifty as well as Nifty positions, all are calendar spread. And I urge you not to see the M2M, because the thing is we also have these October options. So you can see the October options right over here. The thing is the liquidity is very low and these options don't trade pretty often. So you can see for this PE option itself, so the spread is around 40 points. So one tick will actually make this go to 0 and so on. So the thing is October options and September end options as well, the liquidity is not very high. So that's why M2M won't be showing you the accurate number. But I am going to explain the logic behind each of these trades. So I am going to first arrange this alphabetical order wise. And the first short straddle, what we have done is we have actually gone long. So we have gone long in October end 36,000 CEP. And you can see the break even price. So this is the October end 36,000 CEP, and we have shorted September end 36,000 CEP. So we have shorted at following prices. So I'm just going to note that down and I'm going to tell you the logic behind the same, right? We have done a short straddle and we have hedged it with same 36,000 CEP for the next month, right? So you can see the total premium we have paid for the current week, that is 1000 plus 800. So these are the break evens, 1040 plus 800. And on the buy side, we have paid 1340 and 980. So the first idea is, that is 30th of September, which is almost 1.5 months. I have got CE at 1040 and I have got PE 810, right? So both put together, I have collected a premium of somewhere close to 1850 rupees. October end, so this is September end, not 30th of September, October end, right? So CE I have got it at 1340 and PE I have got it at 990. So when I add both of these premiums, it is going to come to somewhere close to 2330 rupees. So the thing is, what I want to tell here is, let's say for another 1.5 months, Nifty currently or Bank Nifty currently is at 36,000, right? So 1.5 months, we are starting right over here. Let's say it goes to 36,500, then it comes to 36,200, goes to 36,800, and then comes down to 36,400, then goes to 36,600, then comes down to 36,000. So let's just assume this scenario. So this is obviously not going to be the perfect scenario. So this is just an assumption. In this case, what is going to happen is after 1.5 months, right? So this premium 1850 is going to turn into 0. So you are going to make plus 1850 profit if this actually happens. So if it is actually ending at 36k, so you're going to pocket this full 1850 premium. Whereas the October end option won't actually end up becoming 0. It will still have a premium of somewhere close to 1200 or 1300, which means from this leg you would have only lost 1000 rupees. So this is the most important thing, because here you have actually gained full 1850 rupees, whereas here I don't think you will even lose 1000 rupees. You might actually end up losing only somewhere around 800 or 900 rupees, because both put together options, they will still have a premium of somewhere close to 1300 or 1400 rupees. So you might actually end up losing somewhere around 850 to 900 rupees, right? So which technically means that you have gained somewhere close to 900 rupees profit just by doing this calendar spread, in case if it is ending at 36k itself. Now the second scenario what we are going to take is, so I'm just going to erase this. The second scenario what I'm going to show you is where Bank Nifty currently is at 36,000 and it goes to 37,000, and finally there's a steep fall of 2000 points and it comes to 35,000, right? So this is one scenario where it goes towards 37,000 and then there is a steep fall, and this is end of September, so this is expiry day. So now what is going to happen, you are going to anyways make a profit of 850 rupees, because PE will be trading at 1000 rupees, CE would have become 0, so you will make a profit of 850 rupees from your September end leg. But the thing is, if there is a sudden crash like this from 37k towards 35k, so it's just an assumption, it might happen, so there is no guarantee it will happen. So in case if this ends up happening, right, so that time this option premium might actually increase, or it might remain the same, because IV of the market will increase or IV of Bank Nifty will increase, and these premiums might not actually end up decreasing. So that is the advantage of having calendar spread. So when the IV is low and later when the IV increases, the far expiry is going to benefit more than the close expiry. So this is one reason where these premiums might not actually end up decreasing at all. So not so much the way we expect, but they might actually only end up losing somewhere around 200 rupees or so on. So this is with expectation that IV will actually end up increasing. So still then you will be making 650 rupees profit. So in case if IV increases quite a lot, you might actually end in profits with these legs, but for that the IV should actually increase very much. So it is not going to happen for small falls of 1500 points, right? So the third case scenario is it starts at 36,000 and either direction, it can go to 37,000, then consolidate, go to 37,500, consolidate, go towards 38,000. And same case with here as well. It can actually consolidate and or fall down, consolidate, go down 500 points, consolidate, go down 500 points. Up till this is 38k and this is 34k. Even now, you have absolutely no problem. Why? Because this option right here, right? So this would be trading exactly at, so this itself covers 1850 points, which means that they'll be trading at their intrinsic values. They won't be actually giving you much loss, only around 150 point loss, because you have already collected 1850 points. But the catch here is, if this happens, this leg might or might not actually end up giving you profits. It really depends on what exactly happens, because we will have to see that, let's say this ends up becoming 2300 and this ends up becoming 150 rupees. So in this case, you might actually have some profits if actually Bank Nifty rallies so much. So that is again debatable, but we will assume that in this case, we don't have any profit or loss. So even then you are going to end with a minimal loss of 150 points in case if market moves so much. So the thing is, finally, the last scenario which I'll be discussing is the market starts at 36,000. So either up direction or down direction. So I don't have a lot of room downside. So I'll just show upside. Goes up, consolidates. So this is 36k. And goes up, consolidates, goes up, consolidates, and goes up to 39.5k. So here in such situations, you will have to do some adjustments. So what adjustments will be doing? So as and when the situation turns out, we will decide what adjustment is ideal. Should we actually end up averaging it by creating a new short straddle. So there are multiple ways how you can counter this position or firefight this position. So there are a lot of ways. So that will be done once we actually get into that situation. Until then, there is absolutely no need to worry what exactly to be done, because when you actually come into that situation, what really matters is what is the IV or what is the sentiment in the market. Is it very bearish or is it very bullish, or whether the market can consolidate here. So there are multiple factors which have to be looked into before actually taking the adjustment trade, right? So this is for the first short straddle which we have done. So the next calendar spread is of 18th August and 26th August. So you can see that for this there are 2 weeks to expiry, and for this there is only 1 more week to expiry, right? So again you can see the premiums we have paid here. So it's around 372, and it is, so totally you can see that for 18th August both put together we have paid a premium of somewhere close to 800 rupees, 820 rupees, and for this we have paid 1100 rupees. So I'm quickly going to write that down. So the idea here still remains the same. So the assumption is, let's say Bank Nifty actually ends at 36,000 itself, so 36k. So this will exactly end at 0, whereas this might actually end up, so let's say your call leg might actually end up at 375 and your put leg might actually end up at 375. So a net of close to 750. In that case, from this particular leg, you would have gained full 800 rupees. And from this particular leg, you would have lost somewhere close to 350 rupees. A net gain of 550 rupees. So this scenario is if market actually ends at 36,000 by next weekend. So not this week. So we are not going to discuss again all the 4 cases which we have already discussed, right? So if adjustments is required at each particular level, we will be doing that and we'll be giving you update on the community tab. So this is the next calendar spread which we have done, that is 18th of August and 26th of August. So you can see here we have done couple of calendar spreads in Nifty as well, that is 12th of August and 18th of August, then 18th of August and 26th of August. So we have done some calendar spreads here as well. So overall we have somewhere close to 2000 quantity short in Bank Nifty and somewhere close to 4500 quantity short in Nifty. That is not exactly short, but calendar spread in Nifty. And you can also see the net quantity is 0, which technically means hedge this perfectly. So there is no additional quantity, or there is no additional quantity on the long side or the short side, which means the position is hedged perfectly. So one more thing you have to remember is, so calendar spreads need not mean that most of the times you are going to go to profits. So end of the day, it's all again, if a position starts to go wrong, it's about how you are going to adjust that particular position, and that is what you have to actually look for. So calendar spreads do not guarantee you profits all the time, but it is good to do in low VIX environment, and I'm going to tell you the reason behind doing this in the low VIX environment. One, the expected movement of index itself is very low. So for example, if by next week Bank Nifty doesn't move anywhere, because obviously the VIX is low, the expected movement of Nifty or Bank Nifty is low, right? So if it doesn't move anywhere, then they are going to give you very good profits. And second one, if actually they end up moving widely, so there's a huge move in Bank Nifty upside or downside, even then IV is going to increase and it is going to benefit the farther expiry options more than current expiry options. So that is one more reason why people prefer calendar in low VIX environment. So the thing is, this doesn't mean that calendars are the best options. They are generally preferred when the VIX is low, because it is going to give you double advantage. One, the expected movement itself is low, and in case if volatility increases quite a lot, you are going to benefit again. So that's the reason we have taken these positions. With the chances that we might go wrong completely and we might have to end up adjusting the positions, right? So we'll see what exactly happens. And as I close the trades, so this Nifty will be being closed on 12th. So I will be giving you update as to what exactly happened with the Nifty trade. And then on 18th of August, we'll be closing 2 more trades. And on 26th of August, again, we'll be closing some more trades. So I'll be updating each and everything as to what exactly happened. So today we have totally discussed 4 scenarios. So scenario number 1, where the market consolidates. So there you will end with profit. So case number 2, where the market moves up, consolidates, and then there's a huge crash. So there also you will end with profit. So 3 is where the market actually ends at your break even, goes up, consolidates, and let's assume this is your break even, market ends right over here. So here no profit, no loss. And finally the last scenario is where the market actually moves up or down, and here you will have to adjust. So these are the 4 scenarios, right? And in this, 2 scenarios are going to give you profit, 1 scenario is going to give you no profit, no loss, and 1 more scenario is going to give you a loss, but if you adjust, maybe you can try to reduce the loss. So I hope you're clear with this, and also the idea of doing calendar splits during the low VIX environment. So with that, we come to the end of this video, and I hope you guys have liked this particular video on calendar splits, and I'll be catching you soon in the next video, and I'll also be giving you the regular updates regarding this trade in the community tab. Thank you so much for joining, guys. See you soon.